All right, welcome everybody. Shane Carter here, Hampshire Capital. As always, with our joined by our VP of Investor Relations, Eddie Austin. Eddie, how you doing today?
Man, I'm doing great. How about you?
I'm doing great, man. Great day to
Good.
be alive.
It is.
So today we are going to talk about investing in a fund versus investing in a syndication of a single asset, pluses and minuses of each, and why we believe that investing in through a fund is potentially a better investment. So why don't you kick us off, Eddie?
Absolutely. So I want to start with, I'm going to be all pro fund guy. That's me. So, and I have people approach me at these investment conferences and Zoom calls and podcasts, and they know that I'm a fund manager that, manage, my own fund, and now starting up a fund for Hampshire Capital, which I've got people excited about. And they always come up to me with the same exact story of, man, I do syndication and I really like the fund model. And some of those people are investors, and some of those are people that are just wanting to start their own fund. So it's very gratifying to me to be able to have that education, to be able to give them my take on a fund. And personally, I don't know why anybody would want to invest in a syndication. I think it would just have to be, if they do invest in a syndication, I would ask them the question, do you know the benefits of a fund? So hence the reason why we should make this video.
All right, so I guess let's go through them top to bottom. What are the benefits of a fund?
Mm-hmm. So I think what a lot of people don't think about with a fund, especially a fund of larger size, is the diversification. Not only, in a syndication, let's just start from the ground level as an operator, what we have to do. So we go to start a fund or start a syndication for a property. We've identified a piece of property. We've done all our documents. We go through that. We start to raise and get people excited about it. We submit our legal docs and they invest with us. And then we go buy one single piece of property and then we start all over again. So it's a hamster wheel. We're constantly just repeat, rinse and repeat, rinse and repeat. So I feel like as operators, we can't be as good as what we really can be, because we would do the exact same upfront process. We would do this exact same process. We're going to raise, we're going to get to the point where we're going to accept in investors, except our investors, they only get that one opportunity. And that one opportunity that's just it. So if Hampshire Capital is identified, we're going to buy 10 assets this year of $60 million in size or $80 million in size. We do all this upfront work. And then we buy this piece of property. But here's the difference. Whenever we buy that property, it's a benefit for us as an operator, but it's a huge benefit to our investors, because once we break through the sky and we get above the clouds, we are able to afford and buy multiple projects. So let's say we have 7 assets inside our fund. Let's say one asset is a very heavy lift up front. And there's a lot of CapEx, there's a lot of things going on, and we have to really knock down the value on the property, or not knock down the value, but we really have to put a lot of upfront money in. And it drags down that 8 pref. Say we're talking about an 8 pref and a 70/30. So when we have a fund, you have a syndication, well, that 8 pref's not going to pay for a while, right?
Yeah, usually the first year, right?
Yeah, so you're going to not have anything going on for the first year. You're going to struggle to make, you're collecting payments, but you're not paying anything out. Then you're going to have a catch-up period, and then I don't know if you truly ever get caught up until the sale, but that 3 to 5 year period, however long your hold is, you kind of ding your investors on that. That's a turnoff to me. With a fund, if we have 6 other assets that are performing extremely well, then all those returns are still paid through the fund, because we're balancing over all these properties. So if one has a problem, it may drag down returns, but it ain't going to stop your 8 pref if we've done a good job up front. So I don't think people really know that a fund has that ability. Just the same as mixing in institutional money with retail money. Everything is in the same exact fund structure. So one person's not getting a return before the other one. One is not more important than the other person. So all we're doing is we're lumping in all this money and we're going and buying these really nice assets, but we're not doing it for one. We're doing it for multiple assets. So hell, if we had a $50 million fund, we could, well, with our size properties, we'd close 3 deals. No, we wouldn't. We'd close 2 deals.
2 deals, yeah.
So if we did a $100 million fund, we had 4 or 5 properties, and say we had a heavy lift on one of the properties we've identified, but it's a 3x multiple. Those investors that jump in that deal are not in that deal, they're jumping in the fund, they're going to have the same return metrics as everyone else, except we bought a 3x multiple. What happens with a 3x multiple? If you have a 2x multiple in your fund, and then you put a property in there, in about 6 months you get it off the ground, it's a 3x multiple, your fund multiple, your returns now go to 2.5x across the board.
Right.
See, I don't think there's many investors that really understand how that works. And I think it's our job to really get that out there to them, because it's a benefit. You people should really think about what you're investing in and how the security of it.
Yeah, no, that's a great point. I'm glad you brought that up, Eddie. So look, let's rewind a little bit. I think, number one, I think for folks investing in a fund, the first thing you have to do is you obviously have to believe in the sponsor. You have to believe in the operator. And so some funds diversify against or within various operators. There's I guess pluses and minuses to that. But in our fund, obviously, we're talking about only investing with Hampshire Capital as the operator. So you have to understand that. You have to understand who we are, what we do, how we do it, and the benefits of that. But then beyond that, now, instead of investing in a single asset deal, you're blended against multiple different assets, potentially different geographic locations. One might be in Dallas, one might be in Jacksonville, one might be in San Antonio, right? So you're investing across different regions and MSAs,
Right.
But then to your point, you're also investing against different sub asset types. They're all multifamily assets, but maybe one is a mid 80s or 90s value add that's going to take a year to really build revenue to a point where it can support that continuous pref payment. And maybe another one is a 2020 or a 2021 that's more of a light value add, pretty stable, property. Maybe just has Gen 2 lease turnovers, and we're really just sort of riding that lease trade out attrition. Mm-hmm. And that's, pumping out a 8-9% cash on cash day one. And so you get those blended returns now of cash on cash metric plus equity multiple returns on the on the value add that doesn't have as much cash on cash initially. So you get a great blended portfolio without really having to do anything.
Right. Now you brought something up a minute ago I want to touch on, because I want to talk to the investors about this. You talked about a fund that would an operator that would invest with other operators. In the fund world, that's called fund-to-fund model. Honestly, I've never seen good returns come from that type of a fund-to-fund world. It's mostly big institutional money that don't care about huge returns, or they just care about stability. So that fund-to-fund, they're drugged down metrics. They really are, because when you take money and you allocate small amounts of equity into large properties, you're sprinkling in money. When you sprinkle in money, it's dragging down your investors' returns, because there's another equity partner that has a first position, a class A equity in the deal. And then the math doesn't work very well. So that particular model a lot of the times referred to as a fund-to-fund. So I really look for a company, I'm going to give some credit, BAM Capital. They do a very good job they are the sponsor. they are the deal source, and they also have their own funds, and they've successfully launched and closed multiple funds. Their return metrics look really good. Same as Grow Capitus. Yep. Grow Capitus is probably one of this is Neil Bala. He's up at what, 40% IRR? The only way that happens is a fund of a large size. So he's probably a 500, maybe $1 billion 506c fund, and he has a bunch of cash flowing monsters inside it. That's how he's making 40% returns. And that's possible. Very possible.
Yeah.
It just takes a very large fund to be able to do that.
Yep. And probably some nice value adds and exits relatively quickly, which would then drive IRR higher as well. So, yeah, no, those are all great points. And so I think so we've got the benefit of, being able to invest across multiple regions, across multiple asset types, and getting that blended return via the fund from cash on cash and equity multiple. What are some of the other benefits that a fund model would produce for an investor as opposed to direct to syndication model?
Well, I think for us, the cool part about us is we already have assets under management. So we already have the operational background. We already have the deal source background. So for Hampshire Capital now opening a fund, the people that invested with us through a syndication model are only going to see even more forward benefits from that. So even with a syndication, I feel like you're limited to, you can't raise money fast enough to buy big deals. Yeah. And I feel like big deals are closed inside funds because you're able to blindly raise a large amount of money to go out and buy several large assets. So your cost segregation studies have even more sauce in it. Your bonus depreciation is a bigger number. Yeah. Everything is a bigger number because you're able to close bigger properties, more properties in 1 year than a syndication. I feel like a syndicator spends so much time in the hamster wheel, they don't get much time to close deals. So I feel with this fund that goes back to our investors, we can close deals faster. Probably shouldn't say this on air, but here's another thing with a fund. If you find a rocket ship of a deal and you got $60 million sitting in the fund, we can go buy that with cash. And we can back it up with a loan. Right. Can't do that with syndication.
Allows us to be more competitive in the marketplace and really pick up amazing deals in this phase of the market.
Well, yeah, we got fire sales going on right now. I mean, I seen a deal this morning come across my phone. It was a Houston property, needed a fast closing, and it's a 213 unit deal. That's somebody that needs a fund right now. Yeah. If the fund was live, $60 million in it, and we fly down there and look at it, and then we put down 2-week closing, and then back it up with debt. Yeah, man.
I think that's a guaranteed close. And to your point, that allows the fund and the operator to really acquire properties at deep, heavily discounted prices. Again, given the market conditions that we're in and likely to be in for at least another 9 months or so, perhaps more longer, right? So that's a great point.
To the investor, now we get a chance to take our current 24% IRR and throw that property inside the fund and put it back with debt in there, and then take our equity back out to buy another property. So if we're at 24% IRR, we could possibly go to 27, and it's still the same investors. You just grow it more and more and more.
That's right.
So I really feel like the fund model is the answer for investors because it's like the S&P 500, except it's not crap.
Yeah.
It is a real piece of property. These are real addresses inside that fund.
Asset-backed investing with cash flow, right?
Exactly. And it's more than one. And like you said, it can be different MSAs. We could have one in Florida, North Carolina, Texas, multiple in Texas.
Right. Yeah, that's a huge benefit. All right. Well, Eddie, thanks as always. I appreciate it. It's been a great conversation, and we'll definitely continue this on another episode.
Yes.
All right. Talk to you later.
Thank you.